Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929 is our telephone number. If you do pick up the phone and give us a call, I'm not going to answer. However, I will question, call, everything you have on that call to me. I'm going to call you right back. Reason is because during the show, so many things come up that people will have a question, and then a segment later they'll have 2 or 3 more questions. Best to hold that number, write down your questions, and then call me later. A lot of people do that, or by email, info@malibufunding.net. Malibu Funding is the nice station that sponsors this show and has been doing so for how many do we have, Daryl, in the hopper right now?
183.
183, and before that we had some other shows on different stations. However, thank you for listening. Thanks for tuning in each and every week. We do appreciate it, and we do appreciate the comments. One of the comments we had was, how come the interest rates are falling again after raising and then falling and then raising and then falling again? And the answer to that is not simple, but the quick down and dirty is that the Treasury bonds that are sold each and every month at Treasury auctions, if their yield, i.e. if I buy something and it pays me, a dividend like it used to be with remember the old savings book accounts at your bank?
Oh, yeah, of course.
What did they used to pay us?
Up to 10 almost.
Yeah, well, I remember 5% when I was a kid. So bonds in general, like a dividend-paying stock, will pay you a certain percentage of that on a yearly basis. So if that particular, what they call a yield, i.e. I'm going to make 1.5%, is a certain amount in relation to what it used to be, the rates will go up. If it's greater than that, i.e. you have to pay more, the rates are going to go up. And if you have to pay less, the rates are going to come down. And that's really the simplified version of it. And what we've got is an interesting two-way street that we have been playing probably for the last 90 days in terms of mortgage-backed securities and treasuries. Sometimes the mortgage-backed securities, which are also sold, but they're sold either by Freddie Mac or Fannie Mae. And by the way, Freddie Mac or Fannie Mae have permission now to combine their portfolios into one offering, i.e. you're not going to have to go to Fannie Mae to buy one offering, Freddie Mac to buy another offering. And neither one of us, you, me, Daryl here, we can't go on the market and buy these. These are institutional, very large investors that buy these, much like they do with the treasury yields in the treasury bonds. So based on all of that, big players affect the mortgage market. So if big players make more money buying mortgage-backed securities, guess what? You're probably going to see the yield, i.e. the amount of money that the treasuries have to pay, go up. Therefore, the mortgage rates will go up. So we're playing this game recently whereby mortgage-backed securities do pay more, which is why the rates have gone up. Interestingly enough, the trade war going on with China, that also affects markets. The reason why is because when we have a normal market, i.e. when we don't have a tremendous amount of foreign dollars influencing the market, i.e. being dumped into treasuries or mortgage-backed securities, what we have is a local or a regional or a domestic market which dictates all of that. But with the trade war being what it is, and we always look, and I've quoted on the show several times, we spend probably, since the trade war started, $1,000 per family, per year, more for products than we would have in the previous year. Now, for some, that's a big number. I mean, if you're making $35,000 a year and your household income is, $50 pre-tax, $1,000 is a lot of money. But if you're making, $300,000, $400,000, $1,000 doesn't mean anything to you. This particular aspect of what the market is and how it works, foreign governments are affected a lot more, foreign countries are affected a lot more by the trade war than we give credit for. Yes, it's $1,000, and yes, it affects a lot of people. But in countries in Africa, in South America, in Asia, certainly in Europe, as we've seen that we're almost in a recession in Europe, the trade war between the United States and China has affected a lot of different supply chain avenues whereby it's really been disrupted. For instance, I have a friend of mine who does exercise equipment, and he buys most of his product from China and has been doing so for years. They assemble it there. They even do some manufacturing there. But a lot of his supply chain runs to the manufacturing, which is done in China, and then it's shipped here. Well, now that there's a trade war going on and the price of his particular goods, because of both the trade war and transportation costs, it doesn't make sense for him to build in China anymore. But how does that affect the downlink trade supply lines that have to go through several companies in the U.S. And some of the suppliers in Mexico? Mexico's been just devastated. Did you read about the GM strike that's happened?
Not that in particular, but I've heard, other businesses being devastated recently by pulling out of Mexico.
Well, one of the problems with this, the UAW is in talks with GM, and they're trying to hammer out an agreement, and they're on strike. 6,000 workers in Mexico laid off. Now, we talk about, how the auto workers and how they, most of the manufacturing has left the U.S. and how we decried the fact that GM, after getting bailed out and after issuing Trump a personal, we're going to keep our plants here, well, they actually shipped out a lot of them. But when the downturn happens, those jobs are not lost in the U.S. Now, I'm not one to be, what's the word, schadenfreude? What is that? Where you're happy that your enemies or your competition is doing poorly. I'm not that kind of guy, because I think absolutely the issue here is jobs lost in a union position. Now, Mexico has a union too. The UAW represents the auto workers there. So in terms of overall labor, it's not a good thing. So given that be what it is and how the supply chain works, what we'd like to see is a more settled economy with no trade war, back to more normalization, and what you would see is a reverberation around the world as to what's happening in other countries in terms of their economies and their employment, and you would see a normalization. But that's not happening. And so as it affects mortgage interest rates, as that money from foreign companies really gets poured into the U.S. Treasuries or mortgage-backed securities, it is holding interest rates really low. So what does that mean for you as a consumer? It means that you can get a mortgage rate now that you couldn't get for 6 or 7 years. And I mean 3.75 or lower for a 30-year fixed rate loan. Let's just look at, these are general averages across the country right now. 30-year fixed rate, 3.75. FHA V8, 3.375. That's a smoking rate right there. Your 15-year fixed at the same, 3.375. And your ARM products at 3.25 to 3.75, depending on the lender. These are smoking rates, rates since 2011, and which is why we've seen a boom in both mortgages across the country, a lessening of any stress in the market related to mortgage fraud, and the reason for that is, and I'll explain it in a different segment, but if you're out there and you're looking for housing has really stopped increasing in value 6 to 7%. We're probably going to see 3 to 4% this year, and that's probably going to hold steady through 2020. So if that is true and your borrowing power just went up, it means that, one, in the refi market, you've got 11.5 million people that can refi now who couldn't 3 months ago. And two, your pool for buyers, i.e. people who can afford a mortgage based on the leveling of prices and based on the fact that your interest rates are lower, you can afford more, is really, really good. So if you're out there and you're looking, it's a great time to buy. We're going to have a couple of people from different lenders on today, plus a real estate agent loan officer who will talk about and to that and tell us how their particular companies and their businesses are dealing with the overall market de-stressing on the mortgage market because the rates went down. Anyway, I'm Jeff Barton. I'm your host in the Mortgage Voice. Thanks for tuning in. As again, if you'd like to see us on Twitter, at Jeff6493. Our YouTube channel is, if you go to YouTube, type in Jeff Barton, the Mortgage Voice, and I pop right up. And so if you can see this show as well as many others we've done, as well as the Las Vegas Real Estate Show, that'd be great. Thanks very much for tuning in. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929, our telephone number over here. Write down the number. And you're going to have questions because this guy coming up in the show right now is a expert in helping solve problems of many different kinds. It's Ryan Mercer from The Lender. He's been on the show before, and I wanted to have him back because the market has changed somewhat, and there's some new products out there. Wanted to make sure you all had the 411 on what's happening. Ryan, how are you?
I'm good. How are you guys?
We're fine. Thank you very much. And as you know, the market and what's happening with rates really changed the game for a lot of buyers. What are you all offering that might assist some of these buyers to get into a home that maybe they couldn't afford several months ago?
Yeah, for sure. First off, obviously, thank you guys for having me.
Sure.
At the beginning of the year, we made a shift from the Fannie Mae, Freddie Mac, FHA business to the non-QM market. And it's really blown up our pipeline. Mm-hmm. And we're focusing, heavy on non-owner occupied business specifically.
Okay.
We have this new product called the NONI, N-O-N-I, and what it is it's a DSCR, debt service coverage ratio program. It's with no job, no income, no reserves. We're offering at a 5.75 par rate. All kinds of little niches to go along with that. The second to that product is for
Can I just, let me stop you for a second because what you just said was incredibly interesting, and I think we got to just make sure that people understand it. So the NONI program, what does NONI stand for?
NONI, N-O-N-I. It stands for non-owner, no income.
Okay, so this is a property that you can buy without showing any income of your own.
Correct, exactly. And I can touch on exactly how that works.
Please do.
Yeah, sure. So it's a 1-to-1 ratio. So as long as the property cash flows at a 1-to-1 ratio, NONI is what we call it. It's a little trademark that we have.
That's good. I like it.
Yeah. So basically, for easy numbers, your PITI payment is $2,000. The rents received on the property or generated from the property need to be $2,000 or more.
Okay.
A niche that we have with that as well is for no pricing adjustment to the rate, we can put your client on a interest only, and we use the interest only payment to qualify at that 1-to-1 ratio.
Okay, and that interest only is what, an ARM product?
It's an ARM product, correct. So we have a 5-1 ARM.
Okay.
It's a 10-year interest only.
Wow. That's a pretty spectacular program. How do you guys get away with that? Is it equity in the property?
It's a business purpose. Exactly. It's a business purpose loan. So it doesn't even follow the standard trade requirements anymore. So your LEs, your CDs, your waiting periods kind of go right out the window. You can even originate this loan in states you're technically not even NMLS licensed in because it is a true business purpose transaction.
Let me ask you a question. Okay, now I have a lot of clients, and I'm sure people out there are saying, well, wait a second, let's say I want to buy a 3 or a 4 unit building, and I want to live in one of them, but I want to rent out the other 2 or 3. Is that possible with this loan?
That's a great question. It is not possible. If you occupy any of the units on the subject property, it disqualifies you for the NONI product.
Okay, and that's incredibly important because obviously your investors need to have a true commercial loan, i.e. you don't want anything to do with an owner-occupied situation.
Correct, and the product's so good, I'll be honest with you, we see some, reverse occupancy issues where people try and squeeze an owner-occupied deal in,
Right.
Because the pricing is so good,
Right.
on an investment property. But yeah, we obviously need to protect the integrity of the product because it is a good product. We don't want to be doing owner-occupied deals on it because the investor's just going to pull the product from us. So. Yeah,
Right.
True investment property product only.
No, I love this product. I mean, anybody who's out there looking for residual income, they're young, they're making pretty good money, can buy a multi-unit building. This is the type of product that really will, and with rents the way they are, only going up because we have such a shortage of housing, this is a pretty good deal.
Yeah, it's a great product, and you're true investors, too. I mean,
Right.
It's an unlimited finance properties, so, Fannie Mae, Freddie Mac have caps on that.
Right.
We'll do a borrower, somebody with 100 units. It doesn't matter. We can do a loan for him.
That's excellent.
Or her.
Now, do you have a FICO score requirement, or how much money in the deal do you have to have?
Yeah, so great questions. We go down to the 620 FICO score on this product.
Okay.
There's 3 pricing tiers. Pretty simple rate sheet. 620 to 639, you're at 6.75 rate. The next tier is middle of the road. You're at 6.25. And at 680 plus FICO, you get that 5.75, which is a hot rate for this product. LTV-wise, I'll touch on that quickly.
Good.
80% on a purchase, 75 on a cash out.
Okay, excellent. No,
Too, let me just touch really quick.
Please.
Sorry, I didn't mean to cut you off.
Yeah.
On the commissions, it's really important that you guys understand this too.
Okay.
I can pay you yield spread on the back end on this because it is a non-trade loan.
Mm-hmm.
So for 1 point commission paid to you in your pocket is a half hit to rate. You can also charge up front as well.
Yeah, this is a smoking deal for many reasons. And anybody who's out there, just shout out your phone number quickly, will you, in case somebody wants to call you direct, Ryan?
Sure. Yeah, my number here is 949-668-7092.
Where do you see most of these loans being done? In the IE, down in Orange County, where?
Yeah, L.A. is a lot of my stuff right now.
Right.
And now that we've opened it up where it's a true business purpose, you can originate them. And we're licensed in, I think, 25 states right now.
I see.
There's only 3 of those states that require either a mortgage broker license or a real estate license. And that's Arizona, California, and Utah. So I'm starting to see more deals in Maryland and Florida and Texas, where we can spread our wings a little bit more and across the country now.
Excellent. Okay, you mentioned another product out there. We have about 3 minutes left. Can you describe what that is, too?
Sure.
Great.
Yeah, that's our second product. Is our bank statement option for self-employed borrowers. Which self-employed borrowers have been in an unserved market, I think, for a long time.
Right.
Bank statements is 12 or 24 months. We're going up to 90% LTV. We have a good price, quick turn times, and competitive debt ratios and things like that when it comes to those self-employed borrowers that, just write everything off on their taxes and take advantage of the tax laws that we have.
What do you see is happening in the marketplace overall? Do you see it the rates staying low because the economy is the way it is, or do you see on the horizon maybe some problems?
I think the rates are going to stay low for a little bit. I feel talking to a lot of my brokers right now is they're just picking off that low-hanging fruit, the refinance business.
Yep.
Which I'm not even focused on that whatsoever. With this non-QM business, our rates don't fluctuate.
Right.
Like the Fannie Mae, Freddie Mac stuff. So I'm seeing a lot of people just, taking advantage of that. Returning their pipelines that they have. But if the rates do start to creep up, you're going to see a lot more of this business coming towards the non-QM, especially with some of the QM patch and the things that are supposed to expire, in 2021.
Oh, that's interesting. There's a lot of things coming. As our business changes a lot, I mean, I think what happens with the consumer is, they want really one loan one time, so they don't follow it. But you and I, we follow it all the time. The way that is done today won't be the way it is done tomorrow. And I think, getting in on what your product is, I love that product, that business loan product on the units. Oh, man, it's just, especially the rate, 5.75. People say, wow, that's really high. Really? Try 18%, way it was back in the 80s when I was first doing loans. I mean, this
Or
is...
taking somebody from a hard money loan.
That's
9,
right.
10, 11%.
That's right.
And it's the easiest loan to sell. You can't get any easier.
Okay, great. Real estate market. I don't know if you do a lot of single-family purchase with your non-QM stuff.
Yeah, we see single family stuff all the time. You know,
Okay.
especially with our owner occupied bank statement programs.
Yeah, is that
it's
popular?
Really picking up.
I know a lot of lenders use it. I don't know if it's popular with you guys.
Yeah, the bank statement deal is probably our second best product.
Mm-hmm.
You know, being the Noni being the number one, focusing heavy on the investment market.
Right.
Number two is the bank statement option. That's our number 2 product.
Huh. Excellent. Hey, listen, Ryan, thanks very much for coming on the show. It's always a pleasure. You gave a great description of that Noni program. I really like it.
Yeah, it's a great product. I'm always around if you guys need me. We're moving lightly and quick on it, especially with no trade requirements. So call me if you need me.
Thanks, Ryan. Thanks very much. That's Ryan Mercer from The Lender. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929 is the telephone number here. If you pick up the phone and call me right now, I'm not going to answer. But if you pick up the phone in 10 minutes, I'm going to call. I'm going to answer you. Reason is that what we found is when we're on the show, there's so much information that we try to get to you. Best thing to do is write down the phone number, write down all the questions you're going to have, and then call me. Or email me, info@malibufunding.net. Malibu Funding is the company that sponsors the show, hires me, and puts me on the radio in order to bring you this particular program, which we've been doing for over 5 years now, hundreds of shows. You can go to YouTube if you want to see past shows, or this show, which will be up there probably on Saturday night, this Saturday night, tonight. Anyway, the YouTube channel is Jeff Barton, the Mortgage Voice. Pretty clever, huh? Anyway, we bring to the show some guests who know more about real estate and loans than I do, and I always appreciate that because there's so many different opinions and way to do things. One of these people works for Malibu Funding is Juanita Potts. She is a loan officer and a real estate agent, been working in the industry a long time. Juanita, how are you? And thanks for coming to the show.
I'm doing great, Jeff, and thanks for having me on.
Thank you very much. Okay, so immediately what comes to mind is lack of housing and how it's affecting prices in our area. What do you think's going on with the housing market that you deal with each and every day from a seller or a buyer standpoint?
What I see from the seller's standpoint is the prices are, it looks like they're leveling off.
Mm-hmm.
I think that it's still somewhat of a seller's market.
Right.
I'm seeing prices a little coming down somewhat, and especially with the interest rates being with the level they're on now, it's making it possible for more people to qualify. But from what I see, it looks like prices are probably leveling off. I don't see them appreciating as fast or as much as they have been in previous years.
I see. Give us a quick rundown of some of the areas that you work in so the listeners will know, especially if they need a terrific agent.
Okay, well, I will cover the entire Los Angeles area,
Okay.
also San Bernardino County.
Okay.
I will go where the business is, so I make myself available. I move around a lot, and I generally like to meet my clients face-to-face, so
Right.
I cover a pretty wide area, and also the San Fernando Valley.
Okay, excellent. I know you as a very detailed, organized person. Tell us how you approach your clients when you first meet them.
What's important to me and to my clients, they want to know that I have the level of experience that I can provide the services they're looking for.
Right.
And the second thing is they like to know that I'm accessible, that when they need to reach me, they can reach me. Now, I may be in a meeting or whatever, so what's key to me is communication and being available to my clients.
Right.
So I that's very important to me. So I deal with that, number one. And the second thing that's very key to me is when I'm working with the client, I like to explain to them the process, the steps that are involved, so they won't be surprised. And then when we're signing documents, it's also important that I explain to them what they're signing,
Right.
People look forward to that, and they appreciated that. And to me, those things are key elements in dealing with my clients.
Agree 100%. Knowledge in the industry is key, but if you can't communicate that, i.e. be accessible, answer questions, be there when questions are asked, it's very difficult for you to be able to share that knowledge. So I agree 100%. Market conditions being what they are, limited product. I guess what we have is a market, as you described it, and I agree with you, is sort of not flattening, but certainly not rising as fast as it was. What do you think is going to happen this fall into the early part of 2020?
Well, I think from what I see, it looks like prices are leveling off.
Right.
And I think that more people will be able to come forward to look for properties. I think that, the summer market is kind of cooled off and people are where they want to be, but there's still a market. I think that things should probably pick up between now and before the end of the year is over. That's what I see in the people I deal with. What do you
tell a seller who's priced their property too high or overpriced it?
Well, how I approach that is I will take a listing and we'll talk about that. And normally what I do is I will say, okay, we will price it at this. I feel it's a bit high, but let's list it at this, and let's put it on the market for a month or two, and let's see what happens. But the only thing I like for my client to do is to take my advice after that time, if the property has not sold, to take my advice as to what I will give them a range, and I always provide the sold comp information. I do update my clients with that on a regular basis.
Right.
And I just like to look forward to having that conversation maybe a month or two after the listing comes out, and we take it from there, and I would hope that they take my advice with the information that I provided with them.
A lot of buyers, and I think you represent buyers as well as sellers, is that correct?
I do.
Okay, a lot of buyers who are looking for real estate are obviously, and the ones I talk to, everyone always says, hey, if you have a deal. Well, I'm always thinking, well, if I had a deal, don't you think somebody would have bought it?
Right.
So buyers in general are looking for, obviously, the best price and the best property. How do you handle their concerns when the market maybe not exactly what they're looking for in terms of either the price or in terms of, the best property?
Okay, well, and I show them what's there.
Right.
I provide statistics. That's important. I send articles, newspaper articles, or information about what's happening in the market. Because for me, keeping my clients advised or informed as to what's going on in the market will help them become more realistic in their search and as far as, what they're looking for. And I get that, give me the deal. I want a deal. Everybody wants a deal. But let's talk about what's happening in the market right now.
Yeah.
And then we'll look at that. We'll take that and make that the next step. So I will provide them information, up-to-date information on a regular basis. So they can get a feel for what's happening in the market because they need to know that.
Of course. Of course, back in the day, and I'm talking 25, 30 years ago, a deal then, right? Even if you paid the highest dollar amount that you can imagine paying for a property in 2000, and let's say the year 2000, 18, 19 years later, that's going to look like a bargain. So real estate is one of those things that, is constantly, especially in Southern California, going up and down, but we've been on an up for many years, 10, 12 years right now. Mm-hmm. And if you bought something at the highest price in 2010, you've still seen a tremendous price appreciation. And I always tell people, real estate is the only way and the best way most people can retire and obtain wealth.
That is correct. I agree 100%.
Now, your experience, your dynamic approach to buyers and sellers. What do you like about the industry?
I love working in the industry.
Mm-hmm.
I love everything about it. I love my job. Mm-hmm. And when you love what you do, you excel at it. That's what I believe. So
I agree with you. I agree. I see your passion because we work together on several different deals. You're always willing to do something that maybe some other agents don't. And that's a hallmark of somebody who likes what they're doing. You're not the type of person that's going to rush out of the office at 4 o'clock if the office closes at 4 o'clock.
That's right.
You know what I mean?
Right. I go the extra mile.
Right.
You know, that's my upbringing. I even when I worked in the corporate industry, I always put the extra in. For me, I'm never satisfied with the 100%. I'll go beyond that. That's what I do. That's what I enjoy. And it allows me to be successful. And then my clients come back. I have a lot of referrals who come to me. And that's a very positive point there.
Excellent. Juanita, could you shout out your phone number to those listening who may want a terrific real estate agent to represent them?
Of course. I have a toll-free number that you can call or text. That number is 800-328-7703. That's 800-328-7703. Juanita Potts, the best real estate agent out there and loan agent.
Excellent. No, that was
serve your needs.
no, that's pretty good. Yeah, that's we'll have to get Alan Mendelsohn to put that one on his TV show.
Okay.
Thank you very much, Juanita, for coming on the show.
welcome.
I really appreciate it, and we'll do it again soon.
Thank you for having me. I look forward to it.
Great. Thank you
enjoy
very
the rest
much.
of the day. Okay,
That's
then.
Juanita
Bye-bye.
Pott from Malibu Funding, and I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929. Our telephone number here. If you've heard something on the show, write it down. Call me later. I will call you back with the answers. And if I don't have the answers, I will give you somebody who does have the answers. This is a very interesting time that we live in many respects. But in the mortgage market and in the real estate market, it's changed, and it changes all the time. Beginning of the year, we thought rates were going to go up to 4.5% to 5.5%. Well, guess what? It did a big reverse, and now we're back down to some of the lowest rates we have had since 2011. So a lot of refinances going on. There's a lot of clog in the market. So if there is some slowdown on your particular loan, that's why. You are among millions of people who are refinancing now to take advantage of these low rates, and I think that's where we are currently in the market. So in order to sort some of this out and give us some program information about how we're doing both for borrowers and for refinance borrowers is Art Navarro from Greenbox Loans. The first time on the show, and I really appreciate him coming on. Art, thanks very much.
Thanks for having me.
No, thank you very much. Tell us a little bit about Greenbox and what it is you guys specialize in.
Okay, so I'm with Greenbox. I'm a senior executive over here. What we for the non. So
Hey, Art, we're having some difficulties with the reception. I don't know if you're on a Bluetooth device, but if you had a handset and could pick it up, that'd be great because we're just getting some reception issues. And Greenbox Loan's been around. Yeah, it's much better. So give us a little bit of a understanding about what you're doing at Greenbox and some of the programs you offer.
Okay, so loans for prime any who traditionally not qualify.
Hey, let us try to call you back, Art. And, the reason being is that this is there's a receptivity issue, and I don't know whether it's the cell phone or whether you have an office phone or such. But let us give you a call right back. Give us 5 seconds. Anyway, that's Art Navarro. We're trying to get a hold of him from Greenbox, just so that we can be able to get some different perspective on loans, loan products, what's out there in the marketplace, how the lenders are handling this overflow of loans from many different corners of the marketplace. Certainly the purchase loans have always been there, with rates being lower. That particular business is up. But the refi business is really doubled, tripled, and the reason being is because we have rates as low as they were in 2011. It is 2019, almost 2020, if you can believe that, and we're still dealing with low interest rates. It's pretty cool. Are you there, Art?
Hey, Jeff.
Hey.
I am. Hey, Jeff. I don't know if this is going to work out. I'm on the 19th floor, and the reception cuts in and out.
I see. It sounds pretty good now. Freeze.
Here. I'm here, so I'll freeze.
Okay, great. Excellent. Okay, so we were talking about programs. What are some of the things you guys are offering that might be different, or maybe some of the successful programs you're currently offering?
Well, right now we offer loans. Right now we're specializing in loans for self-employed borrowers.
Okay.
Self-employed borrowers who can't go traditional full income documentation. We'll go ahead and use either 12 or 24 months of their bank statements, and we'll utilize 100% of their income deposits to qualify them, up to 55% DTI.
Okay, now this particular program, we've seen it on a few other lenders as well. In your particular lending situation, what is it that you do that might be a little bit different, or is it something that you're offering at a lower rate, or what are some of the DTI issues?
A lot of lenders will go ahead and utilize maybe 50 or 75% of income deposits. We'll go ahead and utilize 100% of income deposits. That's number one.
Okay.
Number two, a lot of people won't go to us for our programs. They'll go to us for the structuring of the borrower's needs. And it may be a 12-month bank statement program, a 24-month bank statement program, or a 2-month bank statement program. So we don't necessarily sell programs. We sell solutions to non-prime borrowers via our programs. So our programs are the end vehicle to this.
Excellent. Okay, the 2-month. Okay, so let's say I have 2 months bank statements. How would that work with a borrower like me?
Well, let's assume you're a self-employed borrower. We'll go ahead and use 2-month bank statements. Assuming you have 12,000 deposits 1 month and 14,000 deposits another month, we'll make sure your income will now be $13,000.
Okay.
That income will be $13,000. We'll use that as your income, and it'll just have to be accompanied by a 24-month P&L versus a 24-month bank statement with a 24-month P&L.
I see. So the P&L is key here, and is that an audited P&L? Is that something you make up on your QuickBooks?
No, it's unaudited.
Okay.
It's unaudited based on whatever your borrower deems to be a hard cost for his business.
Okay, excellent. And how successful have these types of programs been for you in solving problems for your borrowers?
Well, we've had great success here. Great success. Assuming you can go 12 months, we'll go ahead and offer 12 months. Assuming you can go 24, we'll go 24. But to have 3 options utilizing 100% of income deposits is kind of unheard in the industry right now.
Right.
Well, maybe only another lender or two are utilizing 100%. Other lenders are using 50 or 75% of income deposits.
2 questions come to mind. Obviously, one is how can you guys do it, and 2, how come other people don't?
Pardon me?
How can you guys do that type of loan at 100% when other banks don't?
I don't know. I don't know who other investors are using on the secondary market.
Right.
All I know is that this is what we're offering at this point in time, and I don't ask what we do. Don't ask any questions on what happens on the secondary market on our side.
That's interesting. No, on the secondary market, of course, it's either hedge fund or Wall Street or some sovereign fund. Who do you guys sell your loans to? Is that available?
You know what? That information I don't have available in front of me right now at this time. I don't.
No, that's okay. I mean, a lot of the, as you know, the Fannie Mae and Freddie Mac stuff have really stifled the market, and a lot of people have gone to the non-QM space in order to solve their problems. Give us some of the examples, other examples of some borrowers maybe who have gone outside of your normal parameters, who you personally might have dealt with that Greenbox has been able to solve the problem of getting a loan.
Okay. Well, we do loans for ITIN borrowers who have used an individual tax identification number to qualify. We do loans for borrowers 1 day out of foreclosure. We do loans for borrowers 1 day out of bankruptcy. These are the type of borrowers we're helping out. Are super non-prime. But we're also helping out the early 8-paper fallout type of borrowers, offering rates as low as 4.5 as well.
Well, that's an interesting point. And what Art is talking about, for those of you who don't know, is that sometimes a lender will have a terrific borrower, what they call A paper, which means an excellent FICO score of over 720, but for some reason just doesn't do the loan. They call that A paper fallout, and Art's talking about helping those people get into the loan that they're looking for. Is that right, Art?
That is correct. From A-paper file, like you said, that just falls out from Fannie Freddie guidelines, all the way to right before hard money, where the borrower just filed bankruptcy or is 120 days out of foreclosure.
And the rates on these loans, you mentioned one rate, but give us a range of the type of rates that you're talking about in all your spectrum of products.
We offer rates as low as 4% for our Alta A-paper fallout, all the way to maybe 9% for borrowers who need to go up to 9%, but have scores as low as 500 as well. Now,
do you do cash-out refis as well, Art?
We do cash-out refis, yes, we do. We do cash-out refis, rate and term refinances, as well as purchase transactions.
And Greenbox, where are they? Are they just in California, or are they all over the nation?
Well, we're based out of Los Angeles, but we're a nationwide lender.
Excellent. And how long have you been working over there for Greenbox?
I've been working for Greenbox for 2 years, but I've been in the industry since 1998.
Yeah, I know. I mean, I know you from other places, right? I mean, it's a small world. I mean, there's only so many of us in the business, and dealing with professionals is always the preferred way to go. When you speak either to a client directly or to a mortgage broker, what do you see are some of the major concerns in the marketplace today?
Some of the major concerns are making sure that the borrower's best interest is at hand right now. So you know what happened in 2008. A lot of governments got semi-loose.
Yep.
We have Dodd-Frank in place, but the market's strong. They just board rates for the A paper, so A paper is getting a little stronger. If and when your borrower cannot go A paper, we're non-prime. We're here to go ahead and pick up that slack.
Yeah, I agree with you about the market. I also agree with you about the safeguards that have been put in place. I think most of the government stuff, most of the Fannie and Freddie stuff, the guidelines and how they review their files are pretty strict. The non-QM, they don't sell to the government or Fannie or Freddie, so that's a private market situation, so it's completely different than 2008.
It is a private market, but we're still somewhat following Fannie Freddie guidelines. They still have somewhat the same investment market, where we don't follow Fannie stringently, but we do somewhat follow Fannie Freddie guidelines just to mitigate risk and make sure that the ability to repay remains there.
Thanks, Art, for coming on the show. I really appreciate it, and I want to take you up on your offer to get your president on the show at some future date. Thanks very much.
Thank you.
Thank you. That's Art Navarro from Greenbox Loans. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929, telephone number here. Pick up the phone, leave me a message, call you right back, let you know what is the answer to your particular question. Maybe you have a question on the housing market. Maybe your real estate market is finally stabilizing and you're wondering if you can afford what it is that you want to buy. I've had several calls this week from past clients. As a matter of fact, this last month, September of 2019, was the most productive month that Malibu Funding has ever had. Now that says something, right? Since 2010, we've had a market which has really been favorable to mortgages. Why? Because the mortgage interest rates have been so low. And we've been refining people really like crazy this last month. I mean, a year ago, and I want to touch upon that. I have another article by Jan Swanson of the Mortgage News Daily that she talks about some of the market conditions. I'll get to that in a second. But the mortgage market is booming. Now, if you're in a purchase right now and you're wondering why things are taking a little long, well, I'll tell you why. You've probably got an extra 2 to 3 million loans in the pipeline that you didn't have a year ago. And so because most companies really didn't see this coming, we were in, I would say a year ago, the interest rates are about 1 point higher. So if you've got 3.375, you were at 4.75%. So that's a big, significant number. And you drop that number, anybody that bought a house at 5%, 5.25%, 4.5% are now, a year later, really interested in refining because you're going to drop not only your rate, but you're going to drop the amount of money you pay every month. So that's why if there is a slowdown, or if your lender or your broker or your bank is saying, hey, we're at a 45-day turnaround, or we're at 72 hours for conditions on your loan. A condition, what is that? That means when you get an approval, they send out a list of items you need. When you satisfy those list of items, that's when they go clear to close and you get your docs. But those items are called conditions on your loan. Everybody's got a different name for things, but really the simple way to look at all of this is real estate and mortgages are hand in hand. If you're in a real estate contract right now, I would suggest that you begin to get used to the idea that your mortgage broker on the purchase side, buyer, is going to ask for an extension. Now, this doesn't mean that they're terrible. It just means that that's the nature of the way the business is right now. And I don't care who you are out there. If you're telling me we can get it done in 30 days, great. Normally we can too. However, if there is such a thing as a slowdown because of the massive amount of loans that they're out there. We're in that market right now. We used to be in that market 2010, 11, and 12, when really real estate prices were still really down and the mortgage interest rates were really down. Problem is, at that time, we didn't have steady employment. We are into how many months do you think it is of increased employment, i.e. expansion in the employment sector? How many months do you think it is?
I think we're into probably 18.
18 months? Oh, no, au contraire. All of Obama's administration and all of Bush's administration, plus almost all of all of Obama's and all of Trump's. So it's something like 400 months in a row. Some crazy number.
But some of that was explained away of people leaving the unemployment because they
No
had
question.
run out of unemployment and they didn't count anymore.
No question.
And they were still unemployed.
Well, right, and a lot of those people have come back to the market. And we're just talking about whatever the government uses for their particular indices when they look at the labor statistics. I agree. So when people go unemployed for a certain length of time, they say they're not coming back. So they don't even include those people. But a lot of those people did come back, which is why when you have huge expanse in the employment, but the number of unemployment doesn't go down, that's the reason, because we're adding people that used to be off the rolls or back on the rolls. It really doesn't affect the percentage because I'm now included in the rolls and I'm employed really is a wash.
So you're saying Bush, Obama, Trump?
Not Bush so much, just Obama and Trump.
So you're talking about
Almost 11 years.
11 years. Yeah,
Right.
'cause you had
8 of Obama and 2.5, 3 years of Trump.
Yeah.
It's pretty amazing
It's a big
figure.
number,
It's
yeah.
a big number. And that's why when we talk about mortgages with that group of people who are steadily employed, it's different today than it was in 2010. The reason is because obviously when Obama was elected in 2008, what we had was a awful economy, but we did have the stimulus, the TARP program. We did have the auto bailout. We had federal programs or bailouts, as everyone calls them. We bailed out the banks in order to keep the economy afloat, and that's when we started to see employment rise. And all of these things affecting employment, obviously, today, because we have really many people who want to work, can work. A lot of people who weren't on, as we were just saying, on payrolls, 3-4 years ago have joined the workforce again, and we have a huge workforce, probably the most people we've seen work in this country ever. And so that's an amazing thing, which also leads to why we have some of the growth rates we have in the economy. I want to quote this article from Jan Swanson. Despite expecting economic slowdown as reflected in the gross domestic product is the all the services and products, everything that's consumed in the U.S., that's what the GDP is. And so when she talks about it, she talks about the GDP down from its average growth of 2.6% in the first half of the year, which was pretty good. Most of Obama's years were about 1.8%, 1.6 to 1.8. When the current administration and President Trump came in, he said, "Oh, I can double and triple that." Well, we're now noticing because the tax cut of last year, which really boosted the economy up into the 3.5% range in terms of its GDP growth, is settling back down to what it normally would be, and we're seeing 2.2%. For the full year this year, going down to, guess what, 1.8% in 2020, which is probably where a large economy like the U.S. should be. And what does this mean for you? It means that we're not seeing slowdowns. We're not seeing recession on the horizon. What we're seeing is strong consumer demand and strong employment. There are some dark clouds out there, but let's say you're looking to buy a house and you're anxious to know what the house prices are going to be next year. As I've explained in an earlier segment, we think they're going to remain, going up in prices, but not to the tune of 5 and 6%, more like 2 to 3%, maybe 3 to 4%. And that's more in line with what we would see traditionally in a non-aggressive seller's market. We'd like to see more of a balanced market. 5-6 months of inventory online is what we're looking for, and that would give you an opportunity, especially with these low interest rates, to be able to go out there, get a house, be able to buy what you want to buy. But as a friend of mine, I don't know, what are the house prices around here going for right now?
500, 600.
Right, and this is out in Ventura. This is where the show is recorded each and every week. We're in Ventura County, Ventura, California, and we're talking, $500,000 is probably average price, right? Which is very similar to San Bernardino and Riverside. And I want to say hi to our great fans out there, the great people who listen in those terrific counties, KCAA, KMET, and certainly our new and growing group out there in Tahoe land. I really want to thank the owner of that station. What a great guy, K Tahoe.
Slap him on the back and say hello.
Exactly right. And thank you very much for everybody who listens to the show. We do give a broad perspective on the economy. We try to bring in some people from outside the state of California to give you an idea of what's going on in other places that Malibu Funding has offices. They're in 10 different states, ranging from the East Coast all the way to the West Coast. We're not here... let's see, we're not in Hawaii, we're not in Alaska. We used to be in Alaska, but not anymore. We never did a loan there, so we get out of there. But let's see, some of the other things in her article, which I think are pretty interesting. We got about a minute left. Unemployment rate is expected to remain at 3.7% through the end of the year, and job creation continued to grow, which is now, what did I say? It's a 107-month positive streak, and 107 times 4 is like 400 week. Right, exactly right. That's what I was talking about. Okay, so 107 months is pretty impressive when you think about it. Let's see, what else is in this? Fed rates, it boosts the housing amount. Housing starts in April. Oh, yeah, the building. Housing builders have really come back because the demand is up and because the affordability is there. That's another great thing. We need million houses a year to be built in the U.S., and there is expected and projected this year and next year to be well over that, about 1,250,000. So that will help also alleviate the demand and also lower prices or keep prices where they are. I'm Jeff Barton. I'm your voice in the mortgage industry. Thanks for listening to the show, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.